Hi traders, welcome to this edition of Market Outlook. Trends, risk, events and trade setups brought to you by Vantage Markets. This is a weekly webinar where we focus on the key events, both technical and fundamental, driving markets at the moment. So while I just let you have a look at the disclaimer, I'll just run through what we briefly want to look at in the next 30 to 40 minutes. We'll follow the usual template, actually. So we'll just look at how markets are set up currently. Some interesting oil news overnight, which had given a bid to the dollar. But those gains are being reined in slightly as we go through the morning session here in the UK. We'll look at how, markets are shaping up really, and global equities especially. We'll look at some of the technicals on the NASDAQ, look at the NASDAQ's outperformance in the first quarter of the year and see where we are going forward. We think a lot of that will be tied to this reset that we're seeing in the Fed rate expectations. We'll show you that on the CME Fed Watch tool, as we always do. And then, as I say, look at some of the technicals around some of the major stock indices. We'll then briefly review some of last week's inflation data that we got. That was both the Eurozone and also in the US with the core PCE data. That's the Fed's favored inflation gauge because it basically takes in a broader amount of data than the widely watched, much more widely watched really, CPI data, which is of course consumer based. And then we'll look at some of the main events for this week. We're heavily data dependent at the moment, really. Central banks are, and that's what's driving markets now as we move on from this sort of previous few weeks around the banking crisis, which of course got us all quite excited and saw a lot of volatility at least. But we'll look at, of course, the main event for this week will be the US non-farm payroll report on Friday. We'll just look at that, and we have a graphic with all the numbers, the important numbers, which we think you should just check out before, of course, that Friday data. We also get data soon, actually, before then. To this afternoon, we get manufacturing ISM data, and on Wednesday we get the services ISM PMI data as well. That will be important for markets and for, as I say, this expectations for the Fed and what they do going forward. We do have two central bank meetings as well, the RBA on Tuesday, the RBNZ overnight UK time, that is, anyway, on Wednesday. So they will be interesting for sure. The RBA markets sort of more convinced than a lot of economists and RBA watchers who are slightly torn actually between the 25 basis point hike and a pause. So we'll just run through that as well with a graphic, I think, with some of those numbers. And all the while looking at the associated currency pairs. So Aussie dollar, we'll look at Kiwi dollar as well. We don't look at that too often, but we will, as well as then the DXY. So that's the dollar index, of course, how that's shaping up ahead of that key Friday data. And if we have time, we'll look at some of the other majors. Hopefully, there's not too much going on in the UK actually this week, but of course that Friday data will drive the dollar and drive those majors. Okay. Just before we, we always like to look at, just before we sort of survey the markets as they are, just currently, year to date, this is FX on the left-hand side. That was last week's performance of the majors. And then on the right-hand side, I just took a snapshot just a few minutes ago. So you can see again, Sterling really outperforming, really, and doing surprisingly well, confounding a lot of experts, shall we say, who've sort of predicted the demise of the pound really this year, I would say. But at the moment, at least, the UK economy is just about holding up, avoided that recession. Of course, 2 quarters of negative growth, that was avoided. And there are hopes possibly, of course, that that the UK does slightly better than has been forecast anyway. Just remembering as well that GBP at the moment, at least, is very much tied to risk sentiment, and so with this pickup in stocks in riskier assets, then cable, sterling has been doing very well. Also, the other European currencies doing well, slightly more hawkish central banks, really, led by the ECB, led by then the S&P following the ECB, especially. They obviously hiked rates by 50 basis points very recently. Looking through that banking crisis turmoil in Europe, in Switzerland, and really instructive that they mean to fight inflation. On the flip side, you've got yen underperforming. Obviously, that had a bid to it during the banking crisis, the safe haven bid, that is, of course. It's more really around Japanese investors, companies repatriating the yen back to Japan, and therefore that haven bid from those investors. But that's now, of course, switched really. The crisis is abating, and yen is suffering. And then you still have some of the commodity currencies sort of slightly doing better. CAD especially sort of bid by better oil prices potentially, and again, not forgetting that the Canadian dollar very much tied to risk sentiment as well, highly correlated with the S&P 500, that is. I did see somebody just raise their hand. We've got quite a few participants this morning, which is really great to see. If you do, I should say, if you do have any questions along the way, however big, however small, please do ask them, and I'll try and answer those as we go, or at least at the end. As I say, any questions, you know, there's so much information to take in, a lot of variables, driving markets, of course, but please do ask questions. That's why we're here. That's why we have these webinars. Firstly, then, markets at the moment, driven really by, well, overnight we had this surprise oil production cut announced by OPEC Plus, which is essentially raising inflation fears and by extension then reducing Fed easing bets, if you like, and ultimately has offered the dollar some support this morning, although, as I said, that has faded during the European session. The cartel, they surprised with the announcement of a more than 1 million barrel a day output cut, only a few days actually after delegates had signaled no intentions to change production limits ahead of the group's monitoring committee this week. Really interesting for oil, as oil prices were dumping really during the crisis, and also during the banking crisis, that is, really falling quite sharply, big sort of 5% plus declines on the day for a few days. And there was obviously a lot of speculation that OPEC Plus, or that the Saudis would come out to try and stem these this bleeding, if you like, in oil. Now, Saudi alone, they've pledged to cut 500,000 barrels per day, and Russia will actually extend the output cuts until year end. We don't actually look often at oil on a technical basis, but let's have a quick look at that now. We've got Brent crude here actually on the daily chart. You can see, if I just go to the weekly chart, you can just see actually, so we're sort of tracking sideways really around sort of $84-85. This is for Brent crude, so not WTI. We can look at WTI if you like shortly. And we just sort of had this big plunge, as I say, a few weeks ago on the banking crisis, breaking below the bottom of that range. We thought sort of $75 or so was support. You can see there 75.30 was the low. We did push below there, but then this black line is the 200-week moving average, and you can see we touched that a couple of weeks ago, and we sort of printed a doji really. So that's where prices sort of open and close pretty much at a similar price, but in between the high and the low of that candle. And you can see we did touch the 200-week moving average at 70.07 there, so just around $70. But then last week you can see a big, decent move higher. Let's just see how much that was actually. So decent move of, so we had the plunge of over 12% on the week, and then that nice pickup of 7% last week. So decent move, and then we're back into this range really now. We've got that light grey line, which is the 100-week moving average. That's at 85.79, top of the sort of range from sort of December. and January, so that will probably prove to be resistance potentially. And then I've got this sort of cycle high, pivot high back from October at 85.79. So yeah, some resistance there. We probably think with 87 around that level, and 89 really sort of being potentially resistance to this move higher. If we just look on the daily, you can see, yeah, we're back into this range. You've got the 50-day moving average. We moved above that, and the 100-day moving average. So really be interesting whether we can push up above that with then, as I say, 89 a target for the bulls. But yeah, oil is volatile, quite tough to trade in my experience sometimes, but always opportunities. And even if you drop down to sort of shorter timeframes, then definitely there are trends to follow and indicators to use. As I say, this move by OPEC Plus really fueled inflation, fears that inflation will prove to be longer lasting for central banks. And there kind of seems to be two sides developing of sorts here. So you've got some central banks like the ECB, they've managed to reliably convey a hawkish message despite that recent market turmoil. Whilst on the other side, we have the FOMC and still that sort of ultra volatile market pricing for their rate path. And the Fed funds futures curve currently implying, I think, around a 60% chance of a May hike and less than 40 basis points of cuts by year end. That was much higher during the banking crisis, of course. But by comparison, on the 24th of March, we had a 24% chance of a May hike. And as I say, around, well, it was 88 basis points of cuts by year end. So that was just a couple of weeks ago, being really volatile in Fed rate expectations. And if we look at the CME Fed Watch tool, hopefully most of you guys are looking at this now, but it's online, free tool, which basically shows Fed funds futures for each specific FOMC meeting. So you can see the next meeting here, 3rd of May, then mid-June, July, and then not one in August, so late September. So that'll be an interesting period over the summer before then November, start of November, mid-December. So 6 more meetings to go for the Fed, not one in August, as I say, but this price is what the Fed is doing, judged by Fed funds futures. So a very active market. And as I say, yeah, 60-40 or so. So 60% chance of a 25 basis point hike currently, as you can see, 4.75 to 5. So we're going to 5.25, 60% chance of that, 40% chance of staying where we are. And if we just look below, you can then see some of these odds and kind of, yeah, 40%. You could just see, yeah, the difference here. A month ago, there was 0 chance that we were staying or going to 4.75%. And a 40% chance that is now. And then if we just go through some of the months, I think probably best now to look at December. So the end of the year, you can see then very little chance that we're staying around the sort of 5% mark, just a 12% mark. 12% chance we stay at 4.75, and then we're dropping. You can see these price cuts, these rate cuts, priced in by markets at the moment. Just sort of recapping on what's going on, actually, just regarding the oil moves anyway, I should have just mentioned oil sensitive currencies, of course, that is, say, the Canadian dollar, the NOK, if you trade that at all, the Norwegian kroner, that is, of course, they're all being supported in the crosses, especially, while sort of sterling, yen, euro, slightly paying the price for this shrinking policy divergence, as I've said. So where those rate cuts were very excessive, 88 basis points, as I say, by year end, now that's sort of halved. Still rate cuts, so priced in. And then if you remember, before the banking crisis, of course, the market had really paid attention to the Fed speakers and the hawkish Fed speakers, and there were very little, if any, actually rate cuts priced in for this year, and that had given a bid to the dollar. But at the moment, we're sort of in that sort of middle land, as I say, 40 basis points or so priced in, and that's given a better outlook slightly to the dollar. The outlook, of course, depends on those expectations, and then also this risk potentially of a hard landing in the US. Markets really, we think anyway, will need to see again these reassurances from the Fed, from Fed Chair Powell, about or insisting that there will be more tightening coming. And as I say, a few months ago, rewind, the market and the Fed differed, and then the market came back to the Fed's way of thinking. Kind of brings to the mind the great phrase, "Don't fight the Fed," which many people forget and have sort of taken that, especially recently, I think in the last couple of years, say 18 months, you know, this credibility issue around central bankers and their forecasts, and people have kind of dismissed in a way that phrase, "Don't fight the Fed." But as I say, before the banking crisis, at least the market was or did come back to the Fed's idea that there would be more rate hikes, if you remember. And in fact, can I show you, say, on the May meeting, let's go back to that, where we had, you know, a decent chance of going to 5.5%, 32%. And in fact, that was probably higher, actually, a few weeks before then even. So 6 weeks ago, say, that was much higher. You remember there was some talk of possibly 6%, you know, at one point, I think was being talked about as the terminal rate in the Fed funds rate. So yeah, a lot to just sort of take in. Hopefully you're understanding that, and that's helping, proving useful for then how markets are reacting. And potentially there is this, we think, if as I say, Fed speakers, Chair Powell comes out banging the drum that the inflation fight is not done, and more tightening, as I say, needs to come, then the market will price in more rate hikes, and that should give more support to the dollar. We've looked at Brent. If I just show you the dollar, of course. So this is the DXY. You should probably all, I guess you know what the DXY is. Obviously made up of 6 currencies in a basket, the euro being heavily weighted towards the euro, the index, about 56, 57% or so. And it kind of mirrors the euro dollar chart if you flip it upside down. So yeah, you can kind of get a picture there. But the DXY always quoted, always an important index, even though we stress it has a heavy weighting to the euro. The next currencies, the sterling and yen, around, I think from memory, 13, 12, 11% or so. So much less weighting on those 2 currencies. But even so, as I say, widely quoted. You can see then, this is the weekly chart. We've got some long-term dotted lines in there back from the pandemic high, and then way back 2017, early 2017 spike high as well. So we've kept those in there because we sort of traded around up and down, higher and lower, if you like, but around there, really, you can see sort of 103, 102 level. And we're just below that now. This is on the weekly. If we look at the daily, you can see those dotted lines, and then the 50-day moving average, the 100-day is the light grey line, sort of 104 now, that cap prices and that push higher when we sort of were looking at those peak rates in Fed funds. So tallying really with that before then the banking crisis. So really, yeah, that's the sort of picture we want to draw to you, or outline at least. And then obviously we've had the banking crisis, dollar going offward really because it's SVB, Signature Bank emanating from the US, of course, and then worries about that then permeating into the wider economy. Slight bit, as I say, today, but you can see if we just look at, say, the 1-hour chart, you can see we've just come off those highs, look above 103, and we're sort of moving lower now below that. So that's the DXY. Support are really around sort of 102. You can see the low last couple of weeks ago at least. 102, where are we? 101.91 actually, but you've got other levels here around 102.04, 07. So just a big figure really probably acting as support. Interesting if we do push lower, and the sort of looks like the path of least resistance really is for lower prices, we'd say. So we break that sort of 102 level, then we're looking at, we think, sort of early February lows around below actually 101 potentially. But much will depend on the data, because these central banks are now heavily data dependent, especially the Fed. And there is quite a lot of data to get through this week, which we'll look at shortly. Just moving to stocks now. Really interesting what is happening in stocks. In fact, if we go to the NASDAQ, first of all, but generally global equities, they were higher last week. Macro data kind of registered close to expectations. And as I say, that confidence crisis in the banking sector is slowly abating, really. It's fascinating, really, how fast investors either forget or really forgive. I think last Friday, or the previous Friday, actually, the global sort of financial markets were very scared. If you remember a couple of the Fridays ago now, this is about Deutsche Bank, which is going to be restructured over the weekend. But then since then, that was kind of scotched, that rumor about Deutsche, and equities really have been marching higher. Last week, they were lifted by cyclical growth stocks, especially. And then we've had the Wall Street fear gauge. So that's the VIX index. That's moved lower again. I think we'll just look at that because always interesting to look at the VIX. So as I say, that's kind of Wall Street's fear gauge, which I just need to find, which is, bear with me. Where are we there? Sorry about that. So we moved a touch higher, actually, but generally the long-term average, it's not something you can trade the VIX really unless you're very specialist. It's based on 30-day options pricing on the S&P 500, and yeah, it's basically Wall Street's fear gauge is known as. When it spikes higher, you can see during that banking crisis up above 30. Just after that SVB, Silicon Valley Bank collapse news, we spiked up and then were sort of elevated for quite a few days and then have fallen back. As I say, the long-term average is around 20, I believe. So you could see probably best on a monthly. If you guys haven't seen this before, I'm not sure, but you can see just the spikes, which we do get from time to time. Obviously, we were above 80 during the pandemic. And then you can see just going back through time, again, GFC crisis, big spike, a lot of volatility there before then coming back to around the 20 level. So it's just always an interesting gauge, sometimes contrarian indicator really for us. If we spike higher, then how long do we last? Really depends. And you can gauge then how fearful markets are. A lot of mainstream news gets whipped up, and then potentially that is, as I say, can be a contrarian indicator. As I said, though, a lot has been moving, well, in equities around the NASDAQ, growth stocks. That closed out its best quarter. His best quarter since 2020, actually buoyed by really big bets on mega cap tech companies. Investors roll back, obviously, those expectations for higher interest rates, as we showed you. The NASDAQ gained around 17% actually in the first 3 months of 2023, rose 1.7% on Friday. Marked the NASDAQ's strongest quarter since the second quarter of 2020. So that's during the pandemic. And even the broader S&P 500 obviously has a lot of tech stocks in, a lot of growth companies as well. That's been lifted by that strength, added 1.4% in on Friday, quarterly increase around 7% for the wider S&P 500. Interesting, I think I wrote in the week ahead piece that we publish on the website that, in fact, if it was equally weighted, the S&P, then it would actually be flat on the quarter. So just something to note there. That means the breadth in some of these stock indices has been anyway pretty narrow, driven all by these massive tech companies. And if we didn't have those, or if the index was equally weighted, then we wouldn't be seeing such big gains. That sort of just brings to us some slight alarm bells about, as I say, that breadth in the moves and that the wider market isn't going up as much as we think. Yes, it's just something to bear in mind. And we've also said over the last few weeks, actually, because of the banking crisis, especially, then we will get these tighter credit conditions. And that potentially means slower economic growth and then weighing on the economy in general, and then also actually allowing inflation to fall even more quickly than before the crisis. We think as well, regulators as well, they're likely to sense a need to be more proactive. That means, of course, those tightening lending standards, as I say, and if that then seeps into markets, then you get a reset of rate hikes, of course, and potentially, well, yeah, the implications for growth stocks or not will be interesting. If we're not quite correct on that, and that markets are still strong, the economy is still strong, the data is still strong, then growth stocks can continue to outperform if these Fed rate expectations kind of stay where they are. Of course, if they flip and the Fed, as I say, comes out more strongly with more hawkish rhetoric, then it kind of seems tough to see how high these growth stocks especially can go. In the meantime, you can see on the daily chart here, we've got the NASDAQ. You can see the RSI there. We're not oversold as we were in, say, the start of February. That's above 70 on the daily RSI. So we're slowly getting there, 68 or so. So we're slowly getting overbought in our eyes, but it looks like a really nice move higher above that previous February high at 12,880. So that is really a decent line of support for us. And sort of target wise, you can see probably we would look at, say, this August high around 13,175. In fact, sorry, we're above that now. So interesting whether we can stay above that. Otherwise, the next level for us would probably be, around these highs, these mid-August highs, sort of 13,685 as a level. So another 500 points or so potentially for the bulls, with support around 12,880. On the broader index, the S&P 500, again, let's pull in the weekly. You can see 3 weeks really strong gains. We've highlighted over the last few weeks just this long-term trend line acted as resistance and now potentially as support, because we couldn't quite markets, we had this big drop off during the banking crisis, of course, but then that decent bid, and then, as I say, 3 weeks of strong gains really. 200-week moving average not touched really in the crisis. So quite interesting that buyers were waiting and have pushed the indices, the S&P 500 anyway, higher. So we've got these sort of levels here now around, if we stay above the 4,000 level, which is key, and also this trend line resistance now becomes very strong support for us. And if we just drop to the daily, the 200-day moving average is around here, always widely watched. That's now at 39.35. Then you've got these other longer term averages that we've pushed above as well. So interesting points, really. 4,000 always a key sort of psychological level. We stay above here, so that's support. And then we've got those early Feb highs now at 4,195, probably the main goal for bulls, stock market bulls anyway. And you can see the daily RSI not really massively overbought at all, so potentially room to go higher. Just dropping to the Dow then as well. That's lagged the tech indices, of course. Value stocks mainly make up the Dow, so less in favor than growth high tech companies, if you like, which prefer this lower interest rate environment, of course. The Dow then sort of tacked around 32,000. You can see there, nice push higher then. This is on the daily, and then we've broken up above the 50-day moving average, possibly You can see that was resistance, so could be support then around 33,133, and then we got the 100-day moving average at 33,352, which sort of tallies with those previous sort of early March highs as well. Push above there, then we're back into this sort of range trading that we had seen a lot of around 34,000, and we've kept in that level. We have done for a few months now. The mid-August high at 34,281, which you can see pretty much capped the upside over the last few months. So probably, yeah, a bit early really to see that. But if we do push above that 100-day moving average, then potentially we get back up above 33,500 or so. That's in the Dow. Okay, last week we just checking out the main event, actually, yeah, from last week. I think always important. We always review some of the main events, see how they came out, of course, and then also, yeah, the impact going forward. I should have just drawn your attention to the Nasdaq chart here. Quickly, just showing you that quarterly gain, really the biggest since the pandemic rebound. You can see there. Of around 17%. So just showing you a really nice chart from the FT. Has how well what a big move it is really that we've seen in stocks. Moving on then to last week's main events, as I say, we'll look at Eurozone inflation first, which is here. Actually used this chart last week, but sort of shows you the big drop that we saw in headline inflation. That declined to 6.9% in March from 8.5% in February. The March decline really widely expected due to energy price developments, which spiked in March of last year on, of course, the Ukraine conflict. So that base effect, therefore, just to explain, is obviously compares prices from now until or goes back to last year-on-year comparison, of course, and they are, of course, then very or currently very favorable for energy developments. Massive spike last year, those of them come back, so you get a big percentage fall there. I think energy inflation fell from around just below 14% to -9% in March. That's year on year, and that's the first decline in energy inflation since February 2021. But because it was so widely known that energy inflation would drop, we have to remember that that's the headline inflation number. Then, of course, there is more focus, in fact, more concerns, if you like, around the other components. So food inflation, which has been the largest contributor to headline inflation in recent months, that actually increased from 15% to 15.4%. This really indicates that price pressures remain high for the moment or in the Eurozone, although they should potentially improve in the headline in the coming months. The main concern really is around wage growth, as it's been rising actually, with the unemployment actually at a low as 6.6% in the Eurozone. And then that means the chances of upward pressure on wages therefore remain. And it also means, of course, stickier inflation, elevated inflation, if you like, on the services side of the economy. But the chief concern for policymakers at the ECB, so a key driver of the euro, is core inflation. So that strips out those volatile food and energy components, and that actually increased from 5.6% to 5.7% in March, with services inflation increasing from 4.8% to 5%. So really key metric for policymakers at the ECB on the Governing Council. Is clearly too high core inflation. That's the focus for policymakers, as I say, overlooking that declining headline inflation. And if we then look at, say, the PMI data in the Eurozone, IFO data, so that's the German business sentiment surveys, they showed actually decent improvements in businesses' assessment of both the current situation and the near future in March. We got that data last week, actually, and across industries, but especially in services. So that's the key focus for the ECB. They are currently expected to hike 25 basis points in May and then another one in June as well. But then after that, potentially seen as the peak. So will be interesting, really. That's what markets have at the moment, the expectations, whether then data shows us or we get strong data, potentially then that will possibly boost more hikes from the ECB and then give a bid to the euro. Certainly, though, if the inflation outlook starts to look slightly more benign, and of course that banking turmoil is sort of easing as well, then you get potentially less aggressive hikes on the table. Technically, or for euro dollar, we have this chart here that you can see. We've seen that bid from the banking crisis lows, if you like. We didn't break actually previous lows from sort of February around 105.37 that we got there. Really interesting, actually, and especially with that Credit Suisse rescue package, if you like. We wrote about that extensively, really, in the daily commentary we put out on the website. Hopefully, you guys read some of that. But really interesting. The Credit Suisse was a global systemically important bank, one of 30 in the world, and that's why really we had those desperate attempts over that weekend to put that package together. I think it was called a shotgun marriage by the FT headline, actually, but very swift rescue package for Credit Suisse, but very quickly absorbed by authorities in a way, with the ECB, especially at the meeting. If you remember, President Lagarde really separating out financial stability on the one hand and then price stability on the other. Price stability meaning sort of inflation fighting. So definitely the measures and President Lagarde really surprised quite well, actually, to many market participants, us as well, having seen so many central bankers and seen how difficult it is to manage expectations. But yes, that was done pretty well, and the fears around the European banking sector, if you like, have really eased back, and you can see that long explanation for this decent bid in the euro. Obviously, it comes against the dollar as well, which is been sold off as well. But we haven't quite got to sort of 110. We've got here, this is now just looking at some of the technicals. We've got some Fibonacci levels here of the 2021 decline that you can see from the highs, sort of above 120, the halfway mark. We mentioned this quite a lot in the daily, actually, 109.42. So we haven't quite got to there. Sort of looks like quite decent resistance, actually, that you can see. Late January, we poked above there, 110.32, but couldn't close above it. And similarly, in the last few weeks, got close to that 109.42 level. So the midpoint of the 2021 decline, that long-term decline, but couldn't push above it. And then on this weekly chart, you've got the 100-week moving average, where that has a lot of validity for us. Not so sure, but at 109.58, so sort of reinforces that 109.42 level for us anyway. And then on the daily, you can see that the move there, the 109.42 level. And not being able to push above there for the moment. You can see today's price action, interesting, that sell-off with the strength in the dollar, and then sort of moved below 108, and then we pushed above it. So, yeah, interesting to see whether we can get above here into the 109 and then 110 region going forward. Also, then we had last week, we had I'm just thinking, sorry, personal consumption expenditures measures, which were the core PCE data, is what I'm trying to say, which is, as I mentioned at the top of the webinar, that's the Fed's favored inflation gauge. It's the measure of inflation that the Fed really takes as its benchmark. The data is just to sort of just go into, the data takes kind of a month to compile, so it is backward looking and tends not to move the market as much as those other yardsticks of prices, like, as we said, the CPI data. But Anyway, that the data doesn't show any significant deceleration for us, and instead kind of backs up the picture from the CPI data as well. Again, you've got this split between services inflation, goods inflation. You've got inflation in services, less so in goods, and that really is the chief problem as well in the US. And core inflation measured this way, so excluding, again, food and energy, edged down very slightly, but not really in the kind of way that might allow the Fed to reverse course within months. So yes, that's a sort of key takeaway for us from that data last Friday. Okay, moving on quickly to this week's main events. We will first touch on, just let me bring up a graphic for you. That's the core PCE, actually should have highlighted so you could see really what I've been talking about, the services, that the white line. Actually, you can see there's still a problem, still rising in services inflation. So, you know, we're sort of getting into the sort of nitty details really in a way of inflation. Goods on the one side, you can see the light blue line really sort of collapsing from those highs, which is really important really, because inflation, the services side is still sticky, still high, and concerning for policymakers, and this is the issue going forward. Right, okay, let's get to the main event of this week. Firstly, well, we'll take the main event, actually, US jobs report. There's also some ISM data as well, but the US jobs report, nice graphic here, hopefully, of all the key numbers that we look at anyway. Consensus looking for 240,000 for the headline non-farm payroll to be added in March. That's against 311, if you remember from last time around, and that beat for, I think it's around 10 times now, but don't quote me on that from memory. But last time we had 311,000 versus 215. Really interesting now. Then we also have, the unemployment rate at forecast to print at 3.6%. So that's 0.2 above 3.4%. But remember, the 3.4% unemployment rate was the lowest in 40 years or so, over 40 years, lowest since May 1969. There we go. And yes, the headline versus consensus would be, back to that, sorry, 240,000 or so. If we think about the 3-month averages, I think there's 351,000 for the 3 months, 6-month average, 336, 12 months average, 362. So potentially looking for a slower number, but again, 200,000 or so is still strong in this part of the cycle. We really want to repeat that. And anything kind of above 200,000 would probably cement the odds of this rate hike, we think, or 25 basis point rate hike in May at the Fed meeting. Average earnings will be a focus as well. They're sort of growing 0.3%, have been for the last few months. Although, unchanged then on I think the previous report. But that may drag down the annual measure to 4.3%. Average work week hours are expected to be unchanged at 34.5 hours. It's worth noting that the data covers the period prior to the recent regional bank crisis. So important to remember, we think, that. And also, actually, it's on Good Friday. So a lot of markets closed. So volatility potentially in those markets which are still open will be high, with sort of less liquidity, less traders at banks at their desks potentially because of the holiday. Looking at other employment data, the global PMI data, which contains employment sub-indices, these improved in the month for the services sector, but pared back slightly in manufacturing. Then we also get, or have had, of course, the weekly initial jobless claims data that actually coincides with the establishment survey window, and those declined. They still remain below 200,000, and that really highlights ongoing tightness in the labor market. We put here in red, you can see it's actually the final jobs report before that Fed meeting on the 3rd of May. I think that's on the Wednesday, the Fed meeting, and then the next NFP is on the 5th. So the Friday, the 5th of May. So this is the last report, jobs report at least, but we do get US CPI data, really, really important figure next week, next Wednesday, 12th of April. So that's to bear in mind with this reaction or the market reaction on the US jobs report. As I say, 200,000 above that, we kind of think will cement this rate hike probably of 25 basis points in May. We showed you it's sort of 60% in favor of, or not in favor, but Fed funds pricing of that 25 basis point hike, 60% at the moment, over 40% for a pause. That was sort of 50-50 before the weekend in the oil news, actually. So that's something to bear in mind. So a coin toss, if you like. But again, very dependent on the data. We also get oh, sorry, that's the RBA. Just before that, we also get US ISM manufacturing data. That will be an important number today. The manufacturing has seen easing actually slightly to 47.1 in March from 47.7 in February. As a basis for comparison, the S&P Global PMI series reported an improvement in manufacturing. But new orders have now fallen for 6 straight months in that sector. I think S&P themselves said unless demand improves, there seems little scope for production growth to be sustained at current levels. But it also said that the manufacturing upside was mainly a reflection of improved supply chains, allowing firms to fully fulfill, backlog of orders. So a slight easing in the manufacturing. Again, if that is sort of proven steady, then that will help boost these odds of a hike and potentially underpin some support for the dollar. The services, that's due on Wednesday. ISM services, that's expected to moderate as well. 54.6 in March versus 55.1 in February. The S&P Global's gauge for the month saw upside in services, actually. But within this release, there will be attention on the price components. So those give us a gauge on inflation, of course. And especially after the S&P said the inflationary upturn was now being led by stronger services sector price increases. And that's linked largely to faster wage growth. So again, you've got this difference between services and goods. Services, it's all about services, the attention on that, and then wages potentially. So any markers, any pointers in some of this data for wages, higher wages, and again, we highlighted that average hourly earnings in the NFP as well, then yes, they will be latched on by markets and drive pricing. I've showed you the DXY. Okay, so that's the main US data. Just we've probably got a bit of time. It's good to see you're all still listening, I think, so that's really encouraging. We'll just run through the RBA announcement, and we've got this graphic here again. Hopefully these are sort of proving helpful for you guys as well to take in. But the RBA announcement, that's on Tuesday, of course, tomorrow. That's probably the more important one than the RBNZ. But as I said, top of the webinar again, there are kind of mixed views on the RBA on whether really the central bank, they'll continue hiking rates or pause. I think Reuters poll has 14 out of 27 economists, they forecast a 25 basis point hike. That would take the cash rate to 3.85%. But so that's kind of even, isn't it? 50-50 for economists looking at the RBA, whereas money markets, they are more decisive. And I think pricing was around 85% or so probability of a pause. So really interesting. That might provoke some volatility for sure in the Aussie. Just as a reminder, and we've sort of got some of those numbers on that graphic. But yeah, the RBA raised by 25 at the last meeting in March, which was widely expected. That was the RBA's 10th straight rate increase. But just remember, the RBA meet every every month, as opposed to, say, the Fed, which has sort of 6-8 week gap, ECB as well, Bank of England too. So RBA sort of different in that respect, meets every month, and therefore where they have more data to base their decisions on, more frequent data, if you like. So yeah, the 10th consecutive rate increase anyway. The board remains, well, it said in the previous meeting anyway, remains resolute in its determination to return inflation to target and expects further tightening of monetary policy will be needed, which was a slight tweak from its previous guidance that the board expects further increases in interest rates will be needed. They also stated that monthly CPI suggests inflation seems to have peaked. And in assessing when and how much further interest rates need to increase, policymakers said they'll be paying close attention to developments in the global economy, of course, trends in household spending, and the outlook for inflation and the labour market. So that meeting really was slightly less hawkish than previously, but it still pointed obviously to further tightening. And in fact, Governor Lowe noted that the bank's closer to a point where it will be appropriate to pause, with the timing, of course, to be determined by data. So those releases haven't helped us that much. They've been quite mixed, which is obviously why we're getting this, a lot of economists torn between a pause and a 25 basis point hike. We've had employment rebound in February. That rebounded following 2 months of contraction. You can see there the unemployment rate fell to 3.5% from the expected 3.6%, while monthly CPI in February was softer than expected. But some economists think that is still, of course, quite elevated. You've also got obviously the turmoil in the banking industry, possible contagion effects there. So there's a lot really to weigh up, even though, of course, as I said, money market's more decisive in a way. The peak rate for the RBA, that's sort of around 4%, I think was above 4.1% before the, sorry, slight typo there, but it was above 4.1% before the previous meeting, now sort of below 4%. So if they hike, we get to 3.85, but then we're looking sort of close to the top. I'll just show you the Aussie chart. Aussie dollar, very cyclical currency, of course, risk sensitive, the Aussie. And you can see the big plunge early in March. And then we've got some fib levels in here of the sort of October move higher. You've got the halfway point at 66, 63 or so, that dotted line. We pushed below there, but didn't really fall convincingly, actually, and we traded sideways, as you can see. Before then, quite a nice move higher today. The 200-day moving average, that's that black line, that's at 67.49, so we're just above there. So that'll be interesting, whether we can push and close above there on a daily basis. You can see we did that, or touched the level a couple of times in late March, but closed much lower. So that'll be instructive. If we can push above and close above here, then we're sort of aiming at these other simple moving averages, if you like, around sort of 68 or so, potentially as a target for the bulls, which was give us above this range trading here. Okay, I think hopefully we've covered a lot. We've taken longer than I thought, so hopefully that's proven useful to everyone. No questions, so hopefully everything's sort of quite clear. Yeah, a lot of data going on. Central banks as well. The RBNZ should just touch upon, is expected to continue hiking. Actually, that's more clear cut, really. They'll raise rates by 25 to 5%, so may not be a lot of volatility around that, more so with the Aussie dollar and the sort of torn expectations by economists. Of course, non-farm payroll top end of the week on Friday will be key for prices then ahead of price action anyway, ahead of next week's CPI data, which we'll run through, as well as them reviewing the non-farm payroll data and other data next week. Okay, I hope that's proven useful. As I say, great to see you all and speak to you, and we'll be with you same time this time next week. Okay, take care out there.